In this video, guys, let's look at what is a take profit order. Very, very valuable order type for your active traders out there. Stay tuned. Hey guys, warm welcome to you. All right, so simple guide to what is a take profit order. You might have heard about this, you might have kind of slightly have understood what's going on, but let me give you a quick guide, a simple guide to how to use it, why it's so important, and what it's all about. Okay, so really definition is this: it's a place or a price we want to lock in profits on our trade. So in other words, you imagine we took a trade, we bought an asset, we bought a market, we bought a currency pair, went long, whatever it is, the market moves up. If the market moves down again, we've never locked in the profits, even though we had those unrealized gain. Let's say we're up $1,000 on the trade, if it comes all the way back again, we've not taken that profit. So we want to be able to take profits. Now, a couple of options we've got. If we're sitting in front of the screen, we can close the trade, manually log into the broker and doing it that way. But a better way, and a way that really utilized by many active traders, is use a take profit order. In other words, what this order does is when you're not at the screen, you place it with your broker and you say to your broker, if the price gets to this level, I want you to take profits on the trade, crystallize those profits, lock it in, close the trade, and give me that profit in my account. So basically it means that if you're out and about, you're doing other bits and pieces, you have a trade on, you know that if the price should move to that level, you'll automatically be taking out the trade at a profit and you look for the next trade. And the theory is, guys, or what we're trying to do as traders, we're trying to run those profits as long as we can on trades. We're trying to cut the losers as quickly as possible. But sometimes it makes sense to have a take profit because it's a key level that you're looking to exit the trade at. Your trade thesis might be, I think we're going to go from here to here, and if that further level is a level that you think is the end of the trade, then you put a take profit order in to crystallize and lock in that profit. Let's look at a couple of examples. So this one here would be a long. Okay, so a long is we're looking to buy something on the expectation that it's going to go higher. Let's say we bought it here, whatever that price may be. We're saying, right, we think the price is going to go to here. Our thesis on the trade is the price is going to go to this 50 level here. Whether it's a currency pair, whether it's a stock, whether it's a futures contract, whatever it may be. And that's where we put our take profit order. So as we leave our broker and we say, okay, take profit. And as we're long, it's a sell order, right? Because we're long, we've bought, and to close that trade, we're looking to sell. So that would be a sell order placed at 50 for the size of the trade that we've got if we want to exit the full trade. Take profits. So now we've got that with our broker, we can be not at the screens, doing other things. If price should happen to push on and finally go up and trigger us there, bang, we get out of the trade. Now, the good thing about that is that if you then are still not on the screen and this thing comes all the way back, what's happened? Great, you've locked in. You've sold it when it's hit there. If you weren't at the screen and you didn't have your take profit, you'd come back to the screen, you might have come back to where you got into the trade or whatever it may be. So good place to lock in profits at a point you know you want to take profits. If you're on the short side, guys, very similar obviously, but with a short, we've gone short, which means we're selling an asset and buying it back. The take profit would be a buy. Okay, so instead of a sell, it would be a buy because we're short something, so we'd want to buy it back at that price. And let's say it's at 20. And again, we can put our buy, I want to buy whatever the contract size, option size we've got at 20. And that means if we're away from the screen, the broker knows, hey, if price comes all the way down here and hits that 20 level, take this trader out of the trade, lock in his profit and deposit his winnings, so to speak, or his profit on the trade into his account. Now, if it doesn't hit there, it's not going to get triggered. So if it goes halfway, you don't want to get triggered. If it carries on and goes all the way through, you're just coming out of that level. You've told your broker to come out of that level, so you'll lose out on any extra gain. But the point is, guys, if it does hit your price level, let's say you traded this channel break, for example, this range break, and you've gone, okay, I think that's a good place to put my profit target. I expect it to reverse back up at some point then. It means you're out of the trade. It means you've locked in that profit. So that's the take profit order, guys. You put it in with your broker, the opposing side to the direction you've taken the trade, and it will automatically take you out of the trade. Whatever you're doing, guys, take care. Keep the risk managed. Make sure you use a stop loss order that goes alongside the profit order, take profit order, to give you the best risk reward ratio possible. Got a video coming out on risk reward ratio. There's a video out there already which will very, very shortly, there'll be all about stop loss orders. So understanding these basics puts you in a very, very good position to move forward with your trading and improve and focus on your setups and your strategies. and leave this thing to kind of take care of itself. You've got your risk managed, you've got your take profit managed, and now you can just focus on picking great trades. See you next one, guys. Take care. Bye-bye.